Welcome, everyone. My name's Don Goff, and for those of you who don't know me, I'm the founder of Next Level Capital, and I'm excited to have you here tonight to share this beautiful opportunity, this Class A property in Avondale, Arizona. I actually went to visit the property a little bit over a month ago. I've been a real estate mentor for almost 20 years now, and I've actually coached hundreds and hundreds of people on how to find deals and how to fund deals. My expertise is in underwriting, keeping people out of the bad deals and helping them identify the good ones. So I have a lot of experience doing this and mostly in Class C and B properties. So I'm super excited when we find a Class A because especially like this one is gorgeous. So I have an engineering background and like I said, I've been in real estate and coaching for a long time. And I actually took a sabbatical for a little while from being an active investor. And I got back involved a couple of years ago investing. And I started investing because I started seeing changes in the market. Things were getting better. And 2025, things got even better. And now we're at the tipping point. If you read anything about real estate and multifamily, you're going to see that everyone is seeing the changes in the market set in 2026 for an epic year. So we're at the right place and the right time to really get going here with it. So I started, you'll see at the top, Next Level Capital, partnering with Viking Capital, and I'm going to get into that in a minute. But before I do, I'm going to introduce one of our panelists, and her name's Jeannie Orlowski. And I'm just going to have her say a little something. Most of you people know her, part of RE Mentor. I've known Jeannie 20 years. I'm super excited to have her with us here and partnering with us to raise money for Viking Capital. So, Jeannie, want to say a little something?
Hi, everybody. How are you? I'm Jeannie. I have been working for RE Mentor we started it in 2002, but I went to work for Dave Lindahl in 1998. So I have been instrumental in raising over $500 million for Dave to buy multifamily real estate. I have been a coach. I have been, you name it, I've been. I don't want to belabor my talents, but real estate is something I started when I was 20 years old. I got my real estate license, my notary public. I still hold them today. I did all kinds of real estate, land, multifamily, office parks, strip malls, you name it. I did it. So it's been a fun ride, and I work for Dave and will until probably he says bye-bye.
Well, thank you, Jeannie, and I'm so glad you decided to partner with me when I brought you this. I know you know the Viking Capital founders just like I do. I coached the founders of Viking before they really took off, and you know them as well, being part of our mentor and then being part of the community for a long time. So I know that's one of the reasons why you're here is because, whenever you're investing in these types of deals and any type of deal and you put your money on the line, you want to know who the operators are. And that's super important to me. That's why I was on the sidelines to find the right partners and ended up hooking up or connecting with Viking again. And I know Jeannie feels the same way. So we've
I've
been friends
known them
now.
for years. For
Yeah, they know.
years, I've known them. I mean, they are just solid, good people.
Yep. And Jeannie's a dear friend of mine. So I'm so excited. We did a lot of stuff on the coaching end, but now I'm glad that we're actually able to partner with some of our most successful clients that came through the program.
Yep.
So thank you, Jeannie. Thanks for being here, and thanks for inviting the folks that you brought to this Zoom or this webinar. And let me now introduce who's going to be presenting tonight, and that's Chris Parrinello. I've been working with Chris for over a year. He's the VP of Investor Relations for Viking Capital. Chris and I now talk 3 to 4 days a week. This is my third fund that I create for Viking Capital. I'm going to let him share his background, but his business acumen is second to none in this industry. There's not many times when I'm learning things after having 20 years experience and coaching almost 2,000 people. It's hard for me to learn from people, and that's one of the reasons when I started investing with Viking myself before I started raising money is I was learning things from Chris, and I was learning things from the founders Vikram Raya and Ravi. And that really meant something to me and how much they knew because I've been in the industry so long. So Chris, with no further ado, I'd love for you to take over from here and share what you love about this opportunity. I know you've been out to the property a few times. You're actually going out there this week to meet with a family office, so you're very familiar with it.
Yeah, no, absolutely. And thank you so much, Don, and thank you so much, Jeannie. I think, I've had the opportunity to really get to know Don. Jeannie, I've just met recently. But, at the heart of real estate and finding success in real estate, it's always going to be a relationship-driven business. And when you're looking at partnering at the highest level and you're buying institutional multifamily real estate, we are honored to be able to partner with folks like Don and Jeannie and all of you as potential investors. So to give you a little bit of background on myself, I've spent a little over 10 years in real estate private equity. It is my entire career. This is what I've done. I started out in Southern California raising capital overseas and Asia and other parts of the world. And I was the managing director of a company called California Golden Fund, where we developed hotels and assisted living facilities. I was there for about 8 years. Even today, still do a lot of work with those two founders. They were, really great mentors for me, Larry Kozma and Jonathan Curtis. And when I moved and transitioned from that sector and those asset classes to multifamily, I started working with a group called Pia Residential in South Florida. That company, very similar to Viking, very similar ethos and business-driven thesis. The main difference was I was raising capital from family offices and smaller institutions to capitalize those deals through, JV structures and really like larger checks, $1 to $5 million checks, higher minimums. With Viking, once I got the opportunity to meet Vikram and meet Ravi, it really resonated with me the idea of bringing this type of real estate to the everyday investor. When I was brought on to Viking, we had about 300 individual LPs, mainly friends, family, and colleagues of the founders. And in the last 4 years that I've been with Viking, we've scaled the investor base up to over 1,200 unique LPs. And some funds that invest with us, I've also brought family offices and institutions from my background to the table. So I think, as we go through the presentation, we're going to really focus on Viking's history, and you're also going to see track record, what, a $1 billion real estate portfolio looks like. So let's get started. All right. So behind Viking, I think, a lot of folks ask me, what is the difference with Viking? What is your secret sauce? And I think that what our core, why we're successful, is the people that we have in our company. We just recently brought on Alex Gill, who is our president. He has 20, 30 years of institutional multifamily, leading companies like Trammell Crow Residential, which was one of the largest privately held real estate companies in the early 2000s. He was also part of the transition team that spun out and built Milk Creek, that went from 0 AUM to over 10 billion in AUM today. Vikram Raya and Ravi Gupta are two founders. My counterpart in the company, the other VP, Judah Fold, is in charge of acquisitions. And then we have Ed Minarchik, our director of asset management. Samantha Parrinello, who's also my wife, is our director of marketing. And then we have, a lot of support staff. In addition to the people that you see here that are our core Viking team members, we also have probably another 10 team members that are not US based that help support different aspects of the company. Okay, this next slide. So this one, I think, really does a good job of showing you, from the day Vic and Ravi decided to partner and start Viking Capital all the way to where we are today. So you can see that, humble beginnings in 2015, 2016, they're under 500 units. And really what this was, them coming together. I think at this point, they're probably getting coached by Don and Jeannie, or maybe just before this. They combined their individual portfolios and decided to launch Viking Capital. Around 2017, 2018 is when they started really getting traction, getting close to 1,000 units under management. They brought on Judah Fold, and they also brought on our original asset manager, Matt Kleka, who's no longer with the company. But that was when they really started to realize, this is scalable. This is something that we're going to leave our, physician background and our W-2 jobs and actually make this into a true real estate private equity firm. Around 2019, 2020, this is where things really started getting interesting and they started building the most of their traction. 2022, they brought me on, and you could see, I think what I would take from this slide more than anything is consistent growth. You have multiple adversity points that could have stopped a company in its tracks and made it stop its growth trajectory. You had COVID, you had in 2022 to 2024, the Fed raising interest rates to recent historical highs from 0 to 525 basis points. And then today you have, what a lot of people see as a really great buying opportunity. We agree, but a lot of working through some of the rate and supply and loan structures from the 2022 era. Moving on. This is what our portfolio in a whole looks like. This is what just over $1 billion of real estate transactions is accumulated with. You can see the top 9 assets are the ones that we've gone full cycle with. We're going to go into the track record card on the back. This is just kind of, photos that kind of go with that portfolio. but there should be. It might have just got stuck. Let's go one more. Here we go. So this is the one that actually has the substance. I always, when I'm, coaching our individual investors, when they're looking at other sponsors or we're reviewing our track record book together, what I like to have every individual LP when they're doing due diligence on a sponsor is to really dig into the deals that have gone full cycle. So it's very intentional the way that we laid this out. We wanted to show where the properties were, the date that we acquired them, the date that we exited, the hold period. More importantly than the years we actually held, what were the projections? And a lot of this tells a story of why the performance was so good. So I would love to be able to sit here and say, Viking is the most amazing sponsor. Everything we touch turns to gold, and we're going to average a 25% return. It's just not the case. Real estate is a tough business, and there's going to be ups and downs in the cycle. What you can tell with a company that's 10 years old is there was a moment from 2016 to 2019 where we acquired these properties where we exited them all between 2019 and 2022. The common theme between 2019 and 2022 was an ever decreasing cap rate situation where you had one of the best selling opportunities in the last 20 years. Viking was able to take advantage of this and through the use of short-term debt with no prepayment penalty, exit a lot of these deals that we really only held for 2 or 3 years. Now, what that resulted in is if you look all the way to the right with,
Oops, sorry.
No problem.
Go ahead.
Projected IRR versus realized IRR, you can see that we exceeded almost all of our metrics. The only metrics that don't look like we exceeded them are the equity multiple, and that's because we were able to create pretty solid equity multiples, but in a much shorter time frame. So the IRRs and the average annual returns really speak for themselves. We also had solid cash on cash. Now, you should be asking yourself, and what I like to be transparent about is we're not in a market right now where cap rates are compressing very quickly. So this changes the playbook and it changes the strategy. So we want to be transparent about what could happen. Now, we anticipated reasonable returns on these deals, just like we are anticipating reasonable returns on all of the projects that we've done since, and that the ability to have flexibility and reduce risk by having multiple exit strategies and the ability to hold on a little bit longer if you're getting into a situation where cap rates are expanding. You never want to be forced to sell at the wrong time. And that's something we've done really very well throughout our track record. Okay. So now on to the current investment opportunity, Avondale Commons. So let's go to the next slide. So here I want to highlight for a second the partner that we have. So Michael Holman and the Overland Group are a really great development partner. The way that we got introduced to this deal is really through Overland Group. We've known Michael for about 5 years. We have also we had been really trying to find the right time to start our first development project. So we had found our developer, and then we wanted to make sure that we weren't jumping into development at the wrong time. Now, some of the reasons that stopped us from doing our first development project in 2022 and 2023 were a lot of the issues that the current sponsor that partnered with Michael to develop Avondale Commons in 2022 faced, which were an unpredictable interest rate environment, not getting a rate cap on their original loan structure, which all construction loans are variable rate. It wasn't that they picked the wrong loan instrument. It was more that they didn't protect themselves with a really tight rate cap. And that led to cost overruns and really created the opportunity for us to come in and create a really nice, safe opportunity for our investors. But what I could tell from visiting this property is, the developer did their job and they did it very well. The property's gorgeous. Don's been out to visit it. They executed really well, and the adversity that this property has faced over the last year or so is all really timing and market based. As we go on to the next slide, you can see some of Michael's other development pipeline. Peoria Gateway is the one that we're developing with them about 10 miles up the road, which is how we've got this off-market opportunity. But you can see, they're really focused in the Phoenix MSA. And then they have headquarters in Phoenix and also in Salt Lake City. So they've also built in Utah quite a bit as well. Now, one of the reasons that we felt like we had the ability to start development is when we brought on Ed Monarchik, he's been with us for about a year and a half. He had himself at another firm developed over $1 billion worth of multifamily real estate, over 26 properties, over 7,000 units, which is larger than Viking's entire portfolio today. He led that. So one thing we didn't want to do was get into a development project and lean on the developer to only be the only one that had the expertise in that arena. So Ed has brought in the ability to really keep the developer honest, both in the Peoria project and now as we bring on Avondale Commons. The other piece is, our president that I mentioned when we were going over our team has 3 times the experience that Ed has. So we're really well protected when it comes to, gray hair on the team that has seen all the pitfalls of development. So, we're going to send out the investment summary and everyone will have a chance to kind of read through everything. I'm not going to go through each one of these things, but I'm going to go through why I really love the deal. What is it that makes me excited about this opportunity? I think the biggest thing that excites me about this deal is the risk-adjusted nature of the investment. So there are deals like our development deal will get you a higher return in a shorter amount of time. But there's entitlement risk, there is execution risk, there is interest rate volatility. All of the same risk factors that affected the original equity that was in this deal exist in a normal development deal. Even in traditional acquisitions that you buy and you're taking full ownership of and replacing the group, pose risk. Are you going to be able to increase rent? Are you going to have the rent growth that you're looking for? Are you going to be able to exit at the right cap rate? What I loved about this deal was we were able to get a really amazing basis. So when you look at this, and there's going to be other slides where we dive into it a little bit more, but you're getting a property that was $120 million to build. That's how much it costs to develop. And the discount to replacement cost, of 20% or so, there's the lender that has evaluated the refinance here, got an appraisal of $105 million, which is about 15 to 20% to replacement cost. Now that's stabilized with no tenants. So when we were able to continue to negotiate with the developer and the existing equity and lower our basis all the way down to the mid 80s, 85 to 87 million, we were ecstatic. And what we ended up with was an incredibly low basis, a minimum return before any of the other existing equity even gets a penny of their principal back of 16% IRR to the deal, which equates to about a 2.1x return over 5 years. So a really solid IRR minimum with the ability to grow even further, an incredibly low basis, and full decision-making rights and control of the deal. So we really got everything that we asked for, and you're getting a flight to quality. So to be able to get a deal like that today isn't uncommon. You could probably find an 80s or a 90s or an early 2000 asset where you're getting a really great discount to replacement cost. You're buying it at like a 6.5 cap. But right now we're able to buy a brand new property that a few years from now is probably going to sell at a 4.5, at worst a 5 cap, and be able to 2x your money with it. And if anything goes wrong, it takes 3 years to stabilize. We sell at a 6+ cap or we get zero rent growth. You have a buffer of $30 million of equity that's sticking in the deal that's just hoping to get their principal back. And that all has to be lost first before it affects your returns. That's really the heart of this deal. So going over the kind of the rudimentary facts of the deal. So you have a 324 unit property in Avondale, the Avondale submarket of Phoenix. The total Viking basis of $82.2 million is the $12 million or the $15 million that we're bringing to the deal. We have the ability to stretch up to 18, but it's not the plan, on top of a $67.2 million refinanced loan. Total equity, including the $30 million of equity that's in a hope note, which for those of you that don't know what a hope note is, it means that they're going to stick in the deal and they have hope that if we sell and we get our 16% IRR, the remaining profits will 100% go to them until they're made whole. And then after that, all profits are split 50-50 amongst our equity and the original equity group. The price per unit of nearly $380,000. The interest rate of the loan is a spread above SOFR, so it will average around 7.5%, but the floor is much lower. If interest rates come down, we can get relief on that 7.5% rate. Now, to be fair, if interest rates were to go up, we don't anticipate that happening, the interest rate could go up, but unlike the original equity, we did purchase a rate cap with our loan.
At 379,000, Chris, what does that represent? I mean, because we're in it for a lot less than that, right?
Yeah, that would be the price per unit at the cost of building it.
Okay, yeah, I just want to make sure everyone was clear on that because I know we're sub threes.
Yeah, I think we're at like 270 a unit.
Yep.
And we're getting about a discount of $100,000 a unit at our basis.
Perfect.
Hold period is for 5 years. Now, we do have, and one of the concessions that we made to the equity and the developer was, we're okay with selling this in 3 years. We won't get a 2x return. You'll still get a minimum 16% IRR of those for those 3 years. Now, what would cause a sale at 3 years would be if something triggered the loan covenants. So if the loan, we missed like a debt yield test or a DSCR threshold, the lender could force a sale, and we would be amenable to that because we're protected. Ideally, we would like to hold for 5 years because in this market, if you have the risk mitigation that we have in this deal and you have an opportunity with that risk adjusted structure to get a 16% IRR for an additional 2 years, most folks want to leave their money in there and let it keep working for them and keep, churning along to that north of a 2x return at the deal level. Some other details about the property itself: 324 units built this year. It will be going into service this year. So for those of you that are interested in bonus depreciation, you have passive income that you're looking to offset, this one should be creating about 40 to 50% of your investment out in passive losses that you'll be able to use in this coming tax year. Well, you'll be able to use it in your next tax filing for the year income you made in 2025. There's 337,000 or so rentable square feet. One thing that isn't on here that I think everyone should know is part of the master plan community is several retail pads. So they've already have leases with the Starbucks. There's like a barbecue restaurant. I think it's a nail salon and a cellular store like a Verizon or something. That has yet to be finished completing construction. But once they get the pads down, we'll get our full C of O, certificate of occupancy, probably within the next 60 days. So that only bolsters, there's also a hotel on the master plan community. So that only bolsters, the demographics of this area. We'll get into exactly what's in the area when we get to those slides later on in the presentation. Okay, so the business plan. So, this is the general business plan for all of the investors, get it leased up and stabilized. So for lease up, we built in 18 to 20 months of stabilization period. To give you an idea of why we did that, for Peoria, it's in an area that isn't as widely built. So we have a 12-month stabilization plan. For this deal, there is competition in the area. And for that, we've added an additional 6 months to get stabilized. Operations. One thing that I think is going to be very like a boost to this property's performance is developers are rarely owner operators. For how great Michael and his team in Overland are at constructing and developing Class A beautiful multifamily, they just don't have the portfolio that we have of active management and knowing how to get through the pitfalls and how to maximize operations for actually running properties. This is our specialty. And I think that even the existing sponsor and Overland see the value that Viking's going to bring here. And that is one of the reasons why they don't mind ceding control to us to run stabilization. We already have our property management team on site. They've been on site for about 60 days. So even before we closed on this property and took over it, they had our property management replace theirs, and we've been running point on this for north of 60 days. The rent strategy. We want to optimize pricing, but anytime you're stabilizing new product, what you really want to do is get occupancy. So your goal is to get to 90% occupancy, because once you have that, even if you've had to give concessions or you're a little bit below market on rents, which bode well for us because we're not trying to drive top line revenue. What really is nice for us in our investment tranche is if we can get to 90% occupancy in the first 18 months, which is the goal, we can immediately refinance into permanent financing with one of the agencies. And when that happens, the deal that's giving 3 to 5% early on in the first couple of years of the hold period immediately transitions to an IO period with a lower interest rate that's fixed. And this investment starts churning out between 7 and 12% annual cash flow. That's really the sweet spot of this deal. And that's why you wouldn't want to sell in year 3, because that's when you're just starting to enjoy this immense amount of cash flow. You want to take that on for the next couple of years and get 8 to 10% cash flow, plus the ability of overwhelmingly a 2x return or a 16% IRR. Retention, this is just part of what we do at Viking as we manage all of the properties we typically acquire. Investors are our customer, but who's really our customer? Who is really the person that makes Viking tick? It's a tenant base. So our reputation with investors is important, and that's what our track record's built around. But we also want to be good stewards of these properties and create good living environments for all of our tenants. And the benefit of doing that, the benefit of being a good operator, that when you take over a property, the tenants are excited that you're there because they've seen the Elevate brand elsewhere, is that you get better tenant retention. So it's always going to be harder to replace a tenant, turn a unit, than it is going to be able to get that tenant to stay on, take on a modest rent increase, and have stability. And that's what you can do when you have best in class operations. These are just, some highlights about the deal. The asset, Don, you've been there, the
Yep.
amenities are second to none. I think this is one of the things that's really going to drive stabilization because you have properties in the area that are also brand new, but just don't have the amenity set that we have at ours. I think that when it comes to the financials, we really have a unique position here because we're preferred equity and we're just sitting in such a great place in the capital stack behind the senior lender that we can weather a really nice bit of adversity without it affecting us at all. Stabilization is one of the things that I keyed in on in the negotiations with Overland. And what I ensured was that while we hope to and have conviction that we can stabilize in 18 months, it could take us 3 years to stabilize, and it's not going to affect our ability of getting our 16% IRR, which, that just bodes well for us as we look into the unknown. None of us have a crystal ball. There's no guarantee things are just going to get better. The Fed's just going to continuously lower interest rates. And if we run into adversity, we have a stable footing in this deal. And then economies of scale. We have a property 10 miles up the road. I'm flying out literally tomorrow to be at this property. And because of what we're doing in Phoenix and having both of these properties, I'm out there at least once a quarter, boots on the ground. Our asset manager goes once a month to do a site visit. We're very engaged on both of these properties. This is some more data about the property itself. You can see with the unit mix, a nice mix between 1 bedrooms and 2 bedrooms, and then these 2, 3 unit plans. But what I like about this property is you basically have garden style multifamily that goes around the amenity sets. These larger units are all townhomes. So they're 3-story townhomes where you have a garage at the bottom floor and then 2 additional stories. And those are really sought after. Out of the 7 or 8 leases that we have in place right now, half of them are these townhome units. Okay, so the return structure. So I'm going to talk about this return structure, which is really the Viking return structure. You all are being presented with an opportunity through Next Level Capital to get to take advantage of what would typically only be available to Viking investors if they invest 500,000 or more. What our investors that invest under 500,000 get is what is referred to as Class B. You get a 7% preferred return and you get an 80/20 profit share of, so you think that 16% IRR over 5 years equates to a 2.1x return. So for every $100,000 invested, the deal is getting $110,000 in profits. In Class B, you're capturing 80% of that $110,000. In reserve class, you're getting 90% of that $110,000. So by partnering with Don and going through Next Level Capital, you are all pulling your capital together, investing at over $500,000, and you're getting much better splits than you'd get if you came through Viking individually. We talked about the returns and the capital stack, but on the left, I think this is a really nice way to visualize how the capital stack is set up. So you have the debt down below. That's the $67.2 million. Then you have Viking's equity of 15 million. So when you think about how we were talking about our basis, that's just those numbers added together. Now, after that, you have the preferred equity is behind us in the capital stack. But what I like to do in order to make the math really make sense is a 2.1x return on $15 million would be about $31 million. So you have about another 16 million that's stacked on top of our equity, which represents our return of principal and our 16% IRR. So that takes you to about $98.2 million. So what that means is that if we sell this property that we already have an appraisal in hand that unstabilized is worth $105 million, and we sell it for anything above $98.5 million, we're getting our 16% IRR. Then any additional money goes to paying back the preferred equity, which is about $4.6 million, plus the preferred equity have terms with a minimum return for them. So about $7.2 million. And then the original $30.25 million in equity. So if we sell the property for $135 million, everybody, we get our win. They get all of their money back. And then any additional money gets split 50-50. And that's how, when you look at a lot of, Vikings marketing, a 16% IRR is our floor. Our ceiling of what we perceive reasonably with conservative assumptions, our ceiling to be is an 18% IRR. But it really could go much higher depending on what the market does. So this is really a breakdown of, as you're investing, what should you expect year over year? So one thing that we don't commonly do in deals that we're doing on our own that aren't in this structure is having an interest reserve that will serve as cash flow when there isn't cash flow. In this deal, we purposefully negotiated it into the deal with the developer and the existing equity because it's really coming at their expense. So it makes it harder for them to get their principal back. But I wanted to make sure that as we presented this deal to investors like you, that you weren't not getting cash flow for the 18 months that we were stabilizing the property. So we negotiated a small but meaningful amount of additional proceeds that would sit in an interest reserve. And starting at the end of the first quarter or the end of the second quarter, we have to see how well the property's doing and how stabilization's going. But we're going to be paying a 3% annualized interest dividend, and those will come out quarterly. Same thing in year two. And then once we start getting to stabilization and we refinance into that perm loan, we have year three at 5, 7, and 7. I think you can take that to the bank. Our internal model shows year three at 7 and years 4 and 5 at 12.
That's with the refi, right?
Yeah, we're not going to promote that because we don't like to build refinance magic into the numbers. We want you to make a decision to invest based off of conservative cash flow assumptions. But I believe that we're going to stabilize within 18 months, get into a perm loan with really nice interest only, and our cash flow is going to hum because we get a full cash sweep of all the cash flow. It doesn't go to any of the existing equity. Only goes to our 15 million and the debt provider. So this is just some information about the loan that we're going to refinance into. $67.2 million principal. The 7.5%, I think it's 355 basis points above SOFR is the way that it's structured. So for instance, today is the 9th. In 2 days, the Fed's going to make a decision on what to do for the December rate cut or stay stagnant. Now, a lot of times they cut rates and treasury yields go up. So we don't really know exactly what's going to happen, but as the Fed marches its path towards whatever equilibrium is for them or whatever they would like to define neutral as, if the SOFR rate or the overnight trading rate continues to sink down, this rate will go down with it. If rates go up, we have a really nice out of the money cap that will not allow this to balloon up to 9, 10, 11%, which is the protection that we want to have because we don't have a crystal ball. We want to make sure that even in the hardest times that we're going to be able to have operating capital, we're not going to have strained cash flow, and that this property is going to be able to get the path that it deserves to really sell at a better cap rate and in a better environment.
So you're saying it would be 7.5 with the rate cap, Chris?
The cap probably isn't at 7.5%. It's probably closer to 8.5 or 9%.
Okay.
It's an out of the money rate caps. It's not going to have an immediate strike at 7.5%. It's more of an insurance policy against like a worst case scenario. But like I said, we feel, and I think what everyone is looking at is that interest rates are going to slightly come down over the next 12 to 18 months.
Yep, sure.
So this slide is important because it shows the value that you can increase by increasing net operating income. It's less valuable to us because we could hit this projection or we could not hit this projection. Our return is built into, this is a basis play, not like a value creation play. But nonetheless, like taking a property from completely unstabilized and getting it stabilized creates a big jump in NOI. And when you do that, that's how you're able to take a property that has an appraisal today at 105 million and make it worth 135 or 140 million. And that, that's the intention. But for the purposes of this preferred equity placement, what I want everyone to understand is we really aren't reliant on getting the highest rent for the first 18 months or making sure that we average 1.5% rent growth year over year, we have some leeway and some give in our assumptions in order to hit the numbers that we need to hit to get the return that's our floor of the minimum 16% IRR.
Yeah, that's what I love about this deal, Chris, is that we have the flexibility now that we're taking it over, where we don't have to be on a certain schedule to lease it up. In the first year, where only it was still predicting to have a high vacancy, but we want to get to occupancy, and our competitors aren't going to be able to keep the rents as low as us. If we have to keep them lower to fill it up, then we can.
Right. That's the thing. Like we're always going to run this property, like we run all of our other properties, which is, with excellence. We want to get the highest NOI. We want to get the highest valuation. And one of the ways that we created alignment with the existing equity in the developer was negotiating getting that 50-50 profit split after they get their money back. That keeps us engaged because if we can get this thing to sell for 145 million, that's an extra $10 million. That's an extra $5 million that gets spread amongst all of our equity. And it certainly helps Viking and its promote as well.
Yeah.
So this slide really goes into what we were discussing with the capital stack. So you can see the exact numbers of the debt plus the money we're bringing to the table, the amount of money it would take to service a 16% IRR, the amount that it would take to make the pref at par to where they're getting their return of capital plus their minimum return, and then the existing equity, plus what a 50-50 split looks like at selling at a 4.5 cap with 1.5% rent growth and stabilizing in 18 months. That has us splitting $13.5 million of additional proceeds. This slide's, I think at this point it's redundant, but Samantha got really creative with the different ways to show this.
It looks nice.
Yeah, the different ways to show this because it is hard to explain this verbally without the graphs in the back.
Right, for sure. Oops, sorry, twice.
This as well. This kind of shows the relationship between our equity and the cost basis, what the sales price that we need to hit in order to get that 16% IRR that we're looking at as our minimum return.
Okay.
I kind of let this out of the bag early on in the presentation, but you're going to have bonus depreciation on this. Now, there's an upside and a downside to having that 30 million of equity stick around. Now, one way to look at it is you have $30 million of equity that's in this deal. It's almost like a zero interest loan. They're not getting any return. They're hoping to get their money back, and they're acting as a buffer, and all their money has to be lost before you lose any of your return. So that's the upside. The downside is them sticking around instead of us buying the deal at this basis and them being wiped out immediately means that they're in the deal and they get a share of depreciation. So it would have usually have been a 75% depreciation number that you could have had from your investment amount in year one. It's reduced down to somewhere between 40 and 50%. Our marketing team averaged it at 45. It could be on the low end, low 40s. It could be all the way up or just above 50. We're still working through that with our CPAs to see exactly which equity gets which credit for what. So there's some tactics that we've employed to kind of make the argument that our equity, since it wasn't used in acquiring the land, is a for instance, land doesn't create any bonus depreciation. It gets pulled out of the cost seg numbers. So there's an argument to be made that we should be able to shift a little bit more of the bonus depreciation our way. That's one of the strategies to get up to 50%. Also, the preferred equity that is in the deal at $4.6 million, they're not taking any depreciation. That was part of their commitment when they came in. So I think this is really advantageous. Many of you might not have passive income, but many of you will. And when you have passive income that you can offset with passive depreciation, it becomes really powerful. At the very least, if you don't have any passive income this year, next year and the following years, you can carry this depreciation forward, and the distributions that you get from this deal are considered passive income. So you can carry this forward and over the first few years of this deal, offset all of the income and not pay taxes on the income until you recapture it in the exit year.
Well, and that's one of the beauties of investing in real estate, right, Chris, is that even on the cash flow, while we're getting cash flow, that's going to be all deferred in taxes as well, right?
Say that one more time.
The cash flow that we get on the property, that will be tax deferred. We can write it off with the depreciation. So we're technically not paying taxes on the cash flow until the end as well.
That's exactly it. And then at exit, you might have to recapture that because the IRS never lets you get out of paying taxes completely. But there's other strategies that you can deploy then whether you're rolling this into another investment, creating more bonus depreciation to offset these gains, or you could take the money and buy an active real estate property and depreciate that an offset. It was really powerful that, this current administration got the permanent reauthorization of bonus depreciation, the ability to accelerate that bonus depreciation into year one, because this keeps that strategy alive and well instead of the step down process we've been in for the last few years.
Well, I know you love to educate people. That's what I've been doing for 20 years. So I know we've talked about this a few times, and I'd like you to just touch base on it. People are going to see deals out there that have 60, 70, 80% bonus depreciation, but there's a downside to that, right? Can you talk a little bit about that and the leverage and why they're getting that higher bonus depreciation?
Right. And this is always something that we want to kind of tread lightly. And when I'm talking to investors, I never try to poo-poo other people's deals. There's lots of deals out there that are really great. We don't have a corner on the market of good deals. However, there is a correlation between risk and getting high bonus appreciation. And you never really want to purely make investment decisions to just offset taxes, especially since when whatever you're investing in sells 4 or 5 years later, you're going to recapture it anyway. And you're going to have to find another way to deploy that capital to offset those taxes. So the reason that leverage plays a big role in this is debt very rarely takes any of the passive losses. If you go back in time to 2022, when people were buying deals with variable rate loans from a debt fund, and they were getting 90% LTV on the loans or 85% LTV on the loans, you had situations where you might be giving above 100% of your investment amount. You put in $100,000, you're getting $120,000 in losses. Now that seems very compelling because you're like, wow, this is $120,000. If I have passive income, I can offset this immediately. In some cases, that's a big chunk, 30% of that, $40,000 in your pocket when you file your taxes. That's compelling. But anytime you highly lever something, it becomes more risky. So that the lender doesn't take depreciation, but they're also in first position. So when there's more money coming from the lender and you're in this 85, 90% loan to value ratio, and you get these really great depreciation numbers, you're in a position to where if something goes wrong, that lender gets to take the property and wipe out all the equity. So it's very important that you think about these things. Just like how I talked about this particular deal, one of the benefits is having that equity as a buffer. The downside is losing depreciation. In my opinion, I would much rather have less risk of my investment not performing and have 20% less passive losses that I can utilize that year, me personally. But, it's not to say that there aren't deals out there. Like the last acquisition we did provided 65% bonus depreciation. It wasn't highly levered. I think the deal is going to do great. Still inherently more risk than this deal, but there's solid deals out there.
Thank you, Chris.
You're welcome. All right. So I think we can run through a lot of this.
hmm
People can look at this when they're going
Sure.
through the performa, but just so you can see where they broke ground in towards the end of 2022, where we are at today. The property has temporary C of O. We can lease up half of the building worth of units. We've already gotten a handful of leases. We're commencing into our equity raise. We're wrapping up. We're hoping to have the majority of funds in the next couple of weeks to close on this loan by the end of the year. And then going into 2026, you're really looking at, say, we're about 1 month into the 18-month stabilization period. So in 17 months, we hope to be fully stabilized at 90% occupancy and going into that perm loan. And then we're anticipating a 2030 exit. We could sell in 2028. Only time will tell to see where the market is and see where the property performance is. But what I would tell every investor to plan on having their money in this deal illiquid until 2030. Here you can see photos of the community amenities. Like I said, really, really high quality. I think as we go through the next couple of slides, it's a lot of photos of the property.
Yeah, I can't go. I already been to it twice, Chris, right? In the spring and then a couple months ago. So I'm looking to see when it's done. It was already gorgeous. I can't wait to see when it's fully done.
Yeah, they really
Completed.
did a fantastic job on this property. I remember before we were in this property, when we were first starting development on Peoria, I went to go view this property just because it was one that was halfway through construction. There was no opportunity for us to partner. They weren't in major adversity yet. And I walked through and I remember going through and being like, wow. I was like, I hope Peoria looks just like this. And I look at the location, and across the street, there's a brand new children's hospital. There's like a Costco down the road, and everything around you is brand new.
Yeah.
I had made the mistake of taking investors in Peoria to do the same thing. And like
Yeah.
they look at me and they're like,
I
Chris,
was
we don't want to
there.
invest in Peoria anymore. We want to invest in Avondale Commons. And I'm like, well, there's some risk there. I think most investors in that deal would rather be in our deal.
Yeah.
But now that we've negotiated the structure and we've reduced the risk for our investors, created that note structure, this deal is amazing. It's really in a fantastic area. So you can see the finishes all top of the line. So that's why, a lot of people have pushed back in my conversations where they're like, Chris, like selling this at a 4.5 cap seems unreasonable. And what I argue back is if you look at most of the big multifamily operators, when I mean big, I mean like Blackstone, KKR, Equity Trust, these big companies, when they buy portfolios, they're buying portfolios of this product and they're usually trading it between a 4 and a 4.5 cap.
Yeah, that's the beauty. But even if we trade at a 5 based on the numbers, we're still going to do really well. So even though, we're anticipating selling at 4.5, which will, even if we sell to 5, we'll still get our returns.
Yeah, I mean, when I did the model testing with Michael, we could sell it a 6
Yeah.
and still get our
Yeah,
returns. So
that's amazing for Class A like this.
we have a really amazing basis. That is the core of this deal and why it's a good opportunity.
Well, it's the standard saying, you make your money when you buy, right? It's nice
Right.
that we don't have to wait for the market and wait for the rent increases and so forth. It's already all built in. We just, we have to fill it up and stabilize it. And so it's a good place to be in.
Absolutely.
And so these are just some more pictures. You want me just to slowly go
Yeah,
through these?
yeah, we can just go through these. I know eventually we can go. We talked about the unit
Yeah, the
mixing.
layout.
Here you can kind of see some of the layouts. The carriage houses are the ones that I was mentioning earlier that are those 3-floor townhomes. They're really, really nice when you walk through them. But even the one bedrooms, you don't have any of those tiny apartments that are like 500 square feet. There aren't studios. The smallest unit on here is 730 square feet. They feel very spacious. So if you compare these rents like to what you see in broader Scottsdale or some of the more expensive areas of Phoenix, you can see why this is in the path of progress. A 15-minute drive to downtown Phoenix, 20-minute drive to Scottsdale, 10-minute drive up to Peoria, where a lot of that chip manufacturing is happening. And you're getting a huge discount in the cost of monthly rent that you're paying. Yeah, here's a good layout of what the property is going to look like. So you can see kind of how far the mixed use and retail is. It's on like the front half of the campus. Now where it says Avondale Boulevard, across that street is where the Children's Hospital is. And then McDowell Boulevard across the street. So this is what's in the master plan. So those areas that we just showed on that site map, that's our mixed use retail, you have confirmed leases from a nail spa. It's like a smokehouse wing place and a Starbucks. In addition to that, I think the other one was a cellular company. You have medical office that is related to the Phoenix Children's Hospital, which is directly across the street. And then you have a hotel that's going to be about 100 to 120 keys.
And it looked like people could be really hit the Starbucks before even getting on the street, right?
Yeah, it's all part of the master
Yeah.
plan community. So it isn't so close to where the retail needs to be completed before people move in. That's why the city wants to see just the pads down and then they'll give C of O. But it is convenient enough to where you don't have to cross any major streets. You can walk from the complex to the retail. Here you can just see the surrounding area. So you can see what's nearby, in addition to the Phoenix Children's Hospital that is directly across the street. You have 3 or 4 other hospital systems. And in these brand new properties where the rents are a little bit more expensive, a lot of times you really do have, you don't have doctors staying there, but you have support staff at the hospital that wants to live nearby. That's usually what is able to have the income to support paying slightly higher rents than the 90s, 2000s properties that are in the area. And, getting that kind of convenience is one of the stabilization plans. You also have a handful of other retail around this big Gateway Crossings shopping centers nearby, which has like really, really strong retail. And what always makes us like when we were looking at this area, when you see a Costco coming, when you see a Best Buy coming, in Florida, we like to say like if a Publix is being built nearby, you know, buy the development site next door. These companies do such a large amount of third market research before they plop down these expensive retail centers that you know that the demand and the demographics in the area have been well thought out and they truly exist. Rent comparisons. Okay, so this is a really important slide. And I think this kind of tells the story of our stabilization plan. So as you look at these properties, these are all of the rental comps. Now, we talked about how this was a really popular area and institutions dumped hundreds of millions of dollars into this area. And this is how it manifested. You have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, including ours, of comparable multifamily in the exact same area. Now, the trend that I implore you to look at is look at the ones that were built in 2023. So you have Christopher Todd Communities, 2 years, 94% occupancy. Village at the Boulevard, 2 years, 93% occupancy. Ironwood Homes at the River Run, 2 years, 94% occupancy. What this tells me is within 2 years, every one of our comps has gotten to full stabilization, even past. Now, look at the deals that were built at various parts of 2024. They have 1 year or less of stabilization period. You have 57% occupancy, 51% occupancy, 71% occupancy. One got all the way to 63% occupancy, which is probably one of our truest comps, right around 320 units, and a couple others in the low to mid 40s. Now keep in mind, this bodes well for our plan because we're saying we're going to be fully stabilized in 18 months. And, one of these that's in the mid 40s, like for them to be much, but you're looking at 360 units. One of these that's in the 50s, 670 units. That is like a mega complex. So I think that we planned out stabilization properly. I think 14 units per month is adequate. I also think that some of this information is dated and there aren't very many units coming online today. All of them are pretty much absorbed. So I think we're going to bode well that they had to do all of this while fighting each other to get to this occupancy. So I think we're in really good shape.
And can you mention that, Chris, just that advantage over the next 2 years, not why more properties aren't coming online, why more development's not being done right now and permits being pulled?
Yeah, it's very rare right now for development to be occurring. So luckily for us, our investor base really wanted to invest in Peoria and we believed in that thesis. But if you look at pipeline maps of units that are getting entitled and ready to build, right now, the majority of equity that supplies development deals is traditionally institutional equity. And institutional equity is just now going pencils up. Now, they've been pencils down for 3 years. The reason that a lot of these properties have come online in the last couple of years is because they were very active in 21 and 22 when debt hadn't gone crazy. Because of debt prices, people haven't come back to the development pipeline. And I imagine this year and next year, you're going to see a lot more development start. But those properties, after they get entitled and after they start construction, and once they start stabilization period, there's no way for them to avoid the fact that they're 3 years behind us. This just kind of shows you those same rental comps where we sit in the market. So we aren't the top rental price, we're not the bottom rental price, but we're right in the middle. And I think we're in the middle on price, but we're towards, I think these top three folks are really our competitors. I think if you go and you look at some of these other properties, they're either smaller, don't have the amenity set, or just aren't the same class as our building. So I actually feel like we're bottom of the market prices for top of the line product. This is what, Don illustrated earlier when we were talking about that discount to replacement cost versus discount to build new today. So our basis is 286 per door. I think construction cost was 380,000 per door. We've identified that you could probably build today for slightly less than they paid because of the lower costs in financing. Okay, and this is really just going to go over a lot of those demand drivers. So I think, one of the things anytime we're looking at acquiring or recapping a deal or developing, we're looking for growth catalysts. We're looking for demographic drivers. And the Phoenix MSA, for all of the problems with overbuilding or slowing in rent growth due to how exciting the submarket is and the general market is, nobody tries to argue the fact that Phoenix isn't just continuing to explode. You have 7.2% job growth. You have really great jobs. You have multiple companies devoting billions of dollars to building chip manufacturing, amongst other things. And we're going to go through a lot of those, I think, in the rest of these slides. So Avondale received an award for, I guess, best use of federal resources in neighborhood development. If any of you guys get a chance to visit this area or local to Phoenix, when you drive through the area, you can tell you feel like you're driving through like a brand new city. So it's a medical corridor. You have 5 hospitals all within a couple of miles, which makes a huge economic impact in the billions, creates well over 25,000 jobs. These are renovations that are very close to the property, but the city, I think what you want to take from this is that the city of Avondale is investing in itself. So there are some areas of the city that now that you've had this explosive growth, the parts that existed a decade ago are all getting refreshed to match. Lots of shopping. We talked about the health corridor. These are just examples of things nearby the property that are landmarks. Yeah, this is just another example of investment. The tech hub, I think, data centers, chip manufacturing, like this is going to be a huge tech hub for the Arizona MSA. And it's due to favorable pro-business policy that is driving everyone to come to Arizona. Also climate. And we can just kind of run through some of these. These are all pretty much the same. This was one
It's a
of the
big one.
biggest ones. Taiwan Semi, $100 billion investment. And I think one that didn't make this slide deck, but when Don and I were at the property together, it had just dropped that like 10 miles away in the Peoria, right near the Peoria development that we're doing, Amcor's investing like $3 to $5 billion to build a smaller facility just like this. You have Hala Vista, which is a $65 billion project, is going to bring 12,000 jobs to the area. NASCAR, $500 million impact. Yeah, and for those of you that haven't been to Phoenix, it's just a really great place. Tons of wealth there. The Scottsdale area was the new big emerging market that felt very new and was very luxurious. But other areas, because of how overpriced that got, have started to sprout all over the MSA. You have a really amazing airport right near downtown. You have great manufacturing hub, and it's the 5th largest city in the United States. You have booming growth, and that's why there's been so much investment in the area. 4 times the national average. They're saying in the next 17 years, the population is going to double, which is insane because when you're
Yeah,
there, you
it's
feel like there's
huge.
already too many people.
Yeah. Well, that's supply and demand, right? So that's just going to be, rent's going to be more stable, a better chance to grow with the population growth and the housing to keep up. So I know they're one of the top migration areas in the country and also as far as population growth. So that's been a trend and it's exciting to see that it's going to continue.
Yeah, you can look at some of the top employers. You have Amazon, Amex, Banner Health. There's just lots of jobs in the area. And, one of the criteria for having a successful multifamily community and to be able to absorb the amount of supply that's been built in Phoenix is having people that can afford to rent these nicer units. Not to mention the single family real estate market in Phoenix has gotten unapproachable.
Yeah, you get that big spread between what you're going to pay for rent and a mortgage. And on top of that, I love how the medical field, especially near Avondale, is really the foundation piece, right? So you have a diverse economy. That's what we always teach too, is you really want a diverse economy. So you have with the tech and everything going on and having the healthcare, it provides a really solid market.
Yeah, this one I found really interesting. I didn't grow up in Arizona, so I never really thought like I grew up in the South Pacific near Hawaii, so water wasn't an issue for me, but water is very much an issue in Phoenix. So there's just natural restrictions to where you can have developments. We were meeting with one of our good friends and investors in this deal who's local to Phoenix, and he was explaining to us that the next kind of mega development is going to be much further out. Like it's actually like another 10 or 15 miles out because it's the only place where people can find land. So areas like this in Avondale, in Peoria, in Scottsdale, they're starting to become considered infill because you can't find land that you can actually develop and build multifamily. People are having to go further west. Mayo Clinic, I think everyone knows this brand when it comes to hospitals, a $28 billion impact to the, or 28 billion to the national economy, but the Mayo Clinic in Arizona, I think it's only like 10 minutes away from the property, creates a $4.7 billion annual economic impact. Lots of higher ed, I mean, Arizona is in Tucson, but these other ones are all Phoenix, ASU, North Arizona, Embry-Riddle, got a handful of them. Intel, another one that has pledged an incredibly large investment into the area with both Fab 52 and Fab 62. And this is
Okay.
the second Taiwan Semi commitment. So two different of the same company, two different plants that they're building. Yeah, SoftBank, $1 trillion proposal. You have lots of professional sports teams. And then one other unique thing, and I don't know if we have a slide for this, but you have like a minor league. It's like a really big deal. Like people come from all over the country to watch all of these minor league teams play. Is it spring training? Something like that.
Yeah, it's a little north of Peoria, right?
Yeah. I
Yeah,
think
the
there might be.
Padres, I think they play there. I can't remember the name off the top of my head right now, but I can envision it right now.
Yeah. Got the People's Open. So this is the Wealth Management Phoenix Open. Not wealth management, waste management.
Yeah.
They're building a humongous theme park in the area. I can't remember exactly what it is. I thought we had a slide. This one isn't it. But you get the long and short is there's a lot of investment that relates to economic drivers and impact in the area. That it's one of the reasons why we've isolated Phoenix as a good market. Now that comes with the risks of oversupply and slowed rent growth, but we feel like we've engineered a lot of that risk out of this deal, and you still get to take advantage of a thriving and booming area, right? And then you have a QR code here. To the extent that anyone wants to jump on a call with me, they'd be happy to set that up. We could all chat together. Really enjoyed presenting this opportunity and really excited to get a deal done with all of you.